Curious about how portfolio management services really work? Want to understand how your portfolios are built, what kind of strategies are right for your financial goals, or is a PMS right fit for you? We are hosting an exclusive webinar, I Thought PMS Universe, Everything You Need to Know. This is your chance to get a complete walkthrough on our PMS philosophy, our strategies from blue chip to multi-cap to small cap, and how we manage risk and performance over a long period of time. Whether you're exploring PMS for the first time or want to get deeper into how we work, this session is designed for you. It's online, free, and open for all. Tap the link attached below to register and get the invite.
In today's video, we're going to talk about the secret to success. Can an investor really experience lower risk and higher return investing? Now, this is something that every investor obviously aspires for, but it seems a little bit too far out of reach. We're often told that investing is a low risk, low reward or a high risk, high reward game. So, if we're trying to flip the game and change the rules of the game, then does it really work for an investor, or is this something that is too good to be true? Well, we're going to break down this myth. Good investing doesn't need to be risky at all. So first, let's try to understand what risk means. In the investing world, there is always going to be uncertainty. So if you think about risk as just uncertainty, then no matter what you do, you're always going to be having some level of risk in your portfolio. But if we start thinking about risk from a more serious perspective, which is the permanent loss of capital, then there is some sense in having a low risk and a high reward game. The idea is that if you have a certain process, and we'll talk about the two things that can really create risk within a portfolio, then you're unlikely to permanently lose capital over a period of time. So what are these two things that we should really be watching out for? The first is in terms of owning a bad investment. So this means if you're looking at an asset that is not governed properly or managed well, then you risk losing capital permanently. The second way to lose money in a permanent fashion is to pay too much for an asset. Now, the basic idea is that if something is worth only 100 rupees and you end up paying 200 rupees for it, eventually people are going to realize that it's worth only 100 rupees. So that extra money that you paid for it is just going to disappear, or it's going to take you a much longer time to earn it back, right? So the asset has to create that value over a period of time to be worth 200 rupees again. So when we keep these two factors in mind, meaning we don't pay too much for what we own, and at the same time, whatever we own has a high quality and is managed well, then we're unlikely to lose money in the long run. This is a very simple formula to ensure that your risk is well managed and is contained. So now let's look at the high returns part of this equation and how can we make sure that we are compounding at the best possible rate. Now, a big part of how you compound depends on your investment discipline. Are you the kind of investor who's able to participate in every opportunity? Are you the kind of investor who has a steady SIP or a monthly investment that's going into the products that you own? Because at the end of the day, it's not about being in the market on the best or the worst days. It's about maintaining that discipline, because in the long run, compounding is what works, and anybody who's consistent is likely to beat somebody who's sporadic in their investment journey. The second thing that can guarantee high returns is to be in the right place at the right time. This means owning the right assets at the right point in the market cycle, booking profits when it's more appropriate to be doing that. So any investor who maintains that discipline in terms of participating as well as profit booking is likely to generate higher returns versus an investor who's just passive and not adapting to the market context. The last point in this game of making high returns is to have broad-based performance. So if you are running your own portfolio or you're entrusting a fund manager to do this for you, whether it's a mutual fund or a portfolio management scheme, what you really need to understand is whether the portfolio is made of one-hit wonders or a winning portfolio. This essentially means that you're trying to decode and see where performance is coming from within a particular fund, which is ideally to study whether there have been one or two ideas that have contributed to most of the returns, or if the returns have come from every part of the portfolio. When returns are more broad-based, you know that there's a process behind this, and it's not just about luck and getting one or two big hits, right? So when you have a process in place that can deliver superior outcomes consistently, then your higher returns are automatically going to be part of the game. So all it takes is a simple formula and a foundation to make sure that you are investing at lower risk levels and are actually reaping much better benefits. If you'd like to explore more low risk, high return options, then get in touch with us, because we have a suite of PMS products as well as a mutual fund distribution service that could help you achieve the kind of wealth creation outcomes that you want.